Good morning. We're excited here at Middlefield to have the opportunity to discuss some of the key thoughts I took away from Enbridge's Investor Day in early March. Joining us to discuss the company's strategy is Gregory L, President and CEO of Enbridge. And Greg, welcome.
Rob, thank you. Great to be here.
Greg, thanks for taking the time. You've had a busy March. Your Investor Day, CIRA Energy Conference last week in Houston. Lots of significant developments at the company. Later this year, the closing of all the Dominion acquisitions, about to create the North America's largest natural gas utility. And that's on top of being the largest liquid pipeline system here in North America. So lots going on. Let's talk about some of these strategic initiatives. One, there seems to be a heightened awareness. I guess the pendulum's kind of swung back to the middle, in my view, that the world needs all forms of energy to achieve the goals of having secure, affordable, and clean power. Enbridge is right in the middle of that, at the center of it. How are these current fundamentals we're seeing in global energy affecting your business?
Well, Rob, first of all, thanks for having me. And other big thing in March, we did close the first of those utilities, and maybe we can come back to that. Look, the whole strategy of the company is that always been that we need a realistic approach to energy transition. We're big believers in liquids, as you well know. We have, the largest liquids operations in North America. We're big believers in gas. I really don't see a future that's very happy for folks, business or as individuals, without natural gas, both in North America and beyond. And then obviously renewable energy is going to play a bigger role, but it's going to take some time to ramp. And if you look at the company, we've structured the company to be very much what we think energy fundamentals suggest. Long-term reliance on liquids, growing need on gas and gas utilities, and then power. And if you just look at our investments, like Rob, right, take the earnings, half the earnings approximately come from liquids, but very small amount of the earnings. Another quarter to 30% by the time we get to the end of this year, you'll have from the gas pipeline business, and about $18 billion of investment. And then the utility, which will be in the other quarter basically, by year end. Lots of investment there too, $3 billion a year, really sees transition going on and continued work on gas. And then the power side, which continues to be less than 10% of the EBITDA, but we're still spending $1.5 billion a year there. So I think it's a natural setup. It's great from an investor perspective to make sure you've got that balanced approach. And, from our perspective, our board perspective, the management team, keeping a focus on fundamentals as opposed to where the herd goes, I think that serves the company best and investors best.
Yeah, it gives you lots of key points there for the longevity of the business anyway, to make us shareholders feel good. Looking at that map behind you, one takeaway of your Investor Day was just how synergistic and hard to replicate that map is. Can you touch on some examples that produce tangible earnings and cash flow benefits for shareholders, just with that, I guess, the spider web of clustering there behind you? How important is that?
Yeah, well, I'm glad you saw that. It's the first thing I look at every day when I walk in the office, and the last thing I see when I go up, because it really isn't, you can't replicate that, right? No matter how much money you had, no matter how much time, just regulatory approvals, siting issues, everything make steel in the ground, if you will, incredibly valuable. So we increasingly find different ways to use that together. It used to be, if you just think about the history of the company, Rob, like was originally in 1949 was just an oil pipeline. Then we picked up the gas pipeline, some utility, and then finally the power. And now, and the reason that's all working together. So let's go to Ohio. Great example. We just closed the gas utility in Ohio. Historically and today, we bring oil pipelines in there to serve the refineries and industrial complexes there on its way further into Michigan and the Great Lakes region as well. We bring our gas pipelines there largely from the south, but also now from Ohio into Ontario. They've been there since the 50s. And the reason why gas pipelines go into Ontario, it serves our utilities there. And all along there's storage. Oh, and by the way, as you would know, Rob, we picked up some renewable assets in Ohio. So now why would you do all that in one one place. Well, Ohio's got an incredible industrial setup. It's obviously a big state. Not physically, but a big state from a population perspective, continues to see growth and needs for infrastructure. So we find we're selling liquids, asset services to customers. We're selling gas, pipeline opportunities and storage to customers, whether they're other utilities or whether they are power plants or industrials. People may be moving off coal or even moving off oil in some cases onto natural gas. That creates an opportunity. And now you got things like data centers and things like that in the Ohio and Great Lakes region. A lot of them want to use some renewables thrown in as well. So you get this synergistic nature of being able to cross sell. We're even finding ways to be able to actually use renewable power to run some of our own assets, whether it's compressor stations on gas pipelines or whether it's pump stations on liquids pipelines. So it really is an incredible setup in terms of being able to use all the various assets together. Again, I think that serves investors. I think that serves our customers, and it sure allows us to create, ebbs and flows in terms of the growth. So you're never just stuck in one energy area, one type of infrastructure. You actually get to utilize all those, which creates that steady results. As again, most investors would know, I think we're up to 18 years in a row hitting our financial guidance and 29 years in a row increasing the dividend. I think that's increasingly because all power is going to be needed, all of the above solutions, as you said in your first comments. And our map actually is a perfect example, and Ohio is a good example. I would say Texas as well. I mean, we could talk about many regions, but increasingly, I hope we'll start to get some operating and commercial synergies going forward that are really going to benefit the company overall.
Yeah, being able to sell the same client many different things, and then having that internal synergies. If you can use some of the assets in natural gas for your own pipelines, can be powerful. Finally, Canada nearing the finish line here on a couple major export infrastructure projects. So hopefully, finally getting the revenue line for the government that we should be getting to help our great nation here. But
Yeah.
the two main projects, LNG Canada, hopefully starting by the end of the year or early 2025, and the expansion of the Trans Mountain oil pipeline. So these long-awaited projects going to give us lots of economic benefits for decades to come. Can you walk me through how both projects affect your business franchises, starting with the implications of TMX on your main line,
Sure.
and then how Canada's involvement in LNG can be a key part of your natural gas growth over time?
Yeah, for sure. I'll definitely start with the main line, but let me remind me to come back and we'll get that interconnection between the gas business right across BC. Just as I talk in Ohio, BC is an interesting example too. So in the main line, just so all your watchers can keep this in mind. Remember, TMX was supposed to come in about 2019. So here we are 5 years later. Obviously, the Western Canadian Sedimentary Basin on the liquid side has continued to grow, and we see another 500,000 barrels of growth through. We're kind of seeing 26, 27. Some people could say 28 kind of thing, but that's much earlier than what people thought. People were thinking just even a year and a half ago out to 2030. My point being is that, yes, TMX is coming on. People were concerned that the main line would lose some of those volumes. We just don't see that. And it's because we're 5 years later, A. B, there's continued growth in the basin. So there's needed egress, so exit into markets. And C, and this is a really important one when you're a producer of oil, we have an incredibly competitive toll because in the last year, we've been able to put a mainline toll agreement, so our major pipeline out of Canada, where our customers now know that we're going to earn somewhere between 11.5% and 14%. We are incented to ship more volumes to get to the higher end. They are incented to ship more volumes because they obviously want to get it to market, and they need more egress. So, and then you've had TMX as a big overrun. We've all heard about that, billions of dollars, multiples above. And as such, if the contract volumes they have a set rate, but the uncontracted volumes, which is a significant portion, they have a much higher toll than what you would see along the main line. So I think the concerns about the main line have been largely overshadowed. I mean, you and I would recall a year ago, people were a lot more worried about it. It doesn't hurt that we've been at record volumes, 3.2 million barrels basically going through there at the end of last year. The first couple of months this quarter, if you just looked at nominations, you would see very similar. And TMX still isn't up and running, right? And I think people need to remember that's not going to happen overnight. Even when they go to landfill, it's going to take some time. So feel great about the main line. You would have seen Colin during Investor Day, very bullish. We're talking about the next round of growth, adding rate base, et cetera, on the main line, just given what our customers need on both sides of the border. If I turn to the gas side of things, you're right. So we've got the existing West Coast pipeline. It's been there since the 50s. We've picked up some storage there. You saw us buy Aiken Creek last year. And then, as you point out, finally, it looks like LNG is going to come off the West Coast. Some folks will know that we have a joint venture there in wood fiber, so in and around Squamish, an LNG project that I think I've been around 30 years. I mean, it started as an import, then an export. You could get the various stakeholders on side, then you couldn't. Now everybody's together. And I think it's because A, there's a lot of gas in Western Canada. B, there's a great need for it in export markets. C, that location is a fabulous location with a deep water, obviously, port. And D, it's going to be the world's cleanest LNG facility because it's largely going to be using hydropower to be able to run. Now, for us, we don't want to take commodity exposure, so we've structured a preferred type return, so we're really not exposed to the commodity. But our main pipeline, the West Coast pipeline, will be seeing multiple expansions to help serve it. And the Lower Mainline. The Lower Mainline continues to need more and more natural gas, as does the Pacific Northwest. And, back to our original points of this discussion, is virtually impossible to put new pipes in place. So we've got well over, $5 billion worth of expansion opportunities along the West Coast system, partially to serve LNG. Storage is going to be needed more. Big ambient temperature swings in LNG, Rob, so that creates opportunity. And we've seen an increase in the price of storage contracts as a result. So we've been waiting for that for a long time, not just in Canada, I would say, also on the Gulf Coast. And we have some storage we picked up there too, serving LNG facilities. So despite what you hear about pauses and stuff, given how long these projects take to build, you're going to continue to see investments on the LNG side. And again, I think that creates great opportunities. Cost of service up there too, right? Some people forget, so I don't want to get stuck into the TMX or some of the other, or the LNG projects to the West Coast. But remember, our system up there, not that you can take that for granted, is a cost of service situation. So that means when we put the cash in, assuming we spend it prudently, and we always do that, then we'll earn a regulated rate of return, which is a little bit north of 10% on 40% equity.
Great. Yeah, it's very exciting times. Maybe let's just quickly touch on food. You wouldn't think about Essex County and Southwestern Ontario being a major part of Enbridge, but we both have ties there. And last time I drove down there, I saw a lot of Enbridge pipe expansion, and it was going to the greenhouses. So just quickly, how Enbridge relates to getting food to our tables.
Yeah, I'm going to be in Chatham later this week. As you know, I used to run the gas utility in Ontario and actually lived in Chatham for a number of years. And I'll be seeing some greenhouses there this week. And that's a perfect example, right? So you've got great access to gas. You've got the Marcellus. You've obviously got gas from Western Canada. You've got the Great Lakes that allow for good transportation in markets in North America, but increasingly beyond. All that, though, needs infrastructure. So Ontario continues to grow rapidly. Last year, I think we added some 43,000 customers. They need another 1,500 megawatts of natural gas power in the next couple of years in the province. We're the big provider of that. And of course, all of that needs storage. So I think it's like Ohio, which is obviously just across the other side of the lake, as you would well know. There's a bit of an industrial rebirth going on there. Data centers, battery plants, all these things as part of energy transition still need a lot of power. And surprise, surprise, they need natural gas. Steel plants in Hamilton region, so a little bit further out of southwestern Ontario, near Lake Ontario and Toronto. A change out of those furnaces, creating steel there from coal to gas. That's creating those opportunities. And as you know, we have a major pipeline down that backbone of Ontario down to Detroit that moves 7 BCF approximately on a cold day in the winter, and that's all great opportunities. So we continue to have some great growth in all the industrial regions. And again, Ohio similar, Michigan you'd see similar activities. Obviously, Texas you see the same kind of thing going on. So wherever capital's needed, and wherever it's welcome, you'll find people building industrial complexes. And if they're building industrial complexes, they need gas. Even if they want to use renewables, which we're happy to sell them, they need, for every megawatt of that renewable power, they need a gas backup too. So that's creating great opportunities as well. So I'm pretty excited about all the industrial things going on as well. I need supportive regulatory regimes, Rob. So we look at that really closely. I mean, just to be clear to the folks watching, obviously the OEB threw us a bit of a curveball last year, but the Ontario government came out right away and said, wait a sec, we need this gas infrastructure. So they're on it. And then, of course, the utilities we're picking up in the US, they have highly supportive regulatory regimes, which actually legislate consumer choice, i.e. making sure that if people want natural gas, they can use it. And hence, that's why you see big growth there. Gas is cheap too, right? Our producing customers don't love it, but that's been great for A, infrastructure, and B, demand.
Yeah, low prices and demand go hand in hand.
They do.
Listen, looking at your stock, we love your low volatility stream of earnings, your attractive dividend. We also want a strong balance sheet and growth of cash flows and growth of dividends. Yeah, we want it all. That's why you're our largest holding here at Middlefield. But can you check all those boxes for income and growth investors going forward?
Yeah, absolutely. And I think that if you look at our balance sheet, we've consistently been saying we'll be between 4.5 and 5 times debt to EBITDA. That's both been the case before the big utility acquisitions and other acquisitions, and with the growth, and it will be going forward. Feel very comfortable being that 4.5 to 5 times. In fact, we're at the very low end of that, even if you exclude the pre-financing for the utilities. So that's one. Two, as you would have seen, we're going to grow the EBITDA probably 7 to 9% with the utilities as we get those in. Now, I still expect DCF, so our distributable cash flow per share, to be in that kind of 3% range, and then 26 and beyond as we get the utilities in to be at 5%, and the same with DPS. So you're getting a mix of growth and obviously well funded. We continue to have about $25 billion of growth in organic capex, well within the balance sheet. And then the dividend's being paid out in that 60 to 70% of the cash flow we produce. Again, that's been very consistent with our policy for a number of years. People have often looked at, well, some of the companies down south have less leverage, and that's on the midstream side. That's true, but they have a bunch of commodity exposure. And as you would know, 98% of our businesses don't have commodity exposure, and we've been very deliberate about that. So you'll get that kind of solid mid-single digit growth. You'll get the similar growth in the dividend with our cash flow. You keep the balance sheet strong and you move forward. Interest rates could come down a little bit. That'd be helpful, I think, to yield stocks. But as you know, we're focused on this for a long term. I'm trying to get people, investors, and the board and the entire management team focused on it at 10 to 12% TSR. And you can double your money every 7 years. If you're looking for 20-25% returns, sure, I guess that could happen in a year. That's not what we are, and that's not what we offer. We give that safe, reliable dividend type utility stock, and I think that served us for 75 years, and it'll serve us for the next 75 years quite well indeed.
Yeah, that lays out your DNA quite well. That we like the predictability. Greg, thanks for taking the time. We'll catch up soon.
Great, thanks, Rob.
All right, perfect.